actually with two special guests who are joining in. We've got Mehrab Irani of Tata Investment and we've got Craig Earlham of Oanda joining in from London. Gentlemen, both of you, thanks so much for taking time out for us. Mehrab, let me kickstart things with you and Reliance Industries, but of course we have to talk about it. Today it did a good part of the heavy lifting for the markets, lending support. Now that you've got a corporate scorecard that's come in better than what was expected, what's the outlook for this stock?
Yeah, good evening, Tanya. If you see, this stock has actually already outperformed over the last few sessions, and because of that, the market has been quite stable. If this had underperformed, I think the market had fallen more. So I think given the good set of numbers, it's a little difficult to expect the further outperformance because it has already outperformed over the last few days. If you see, the overall results season has already started, and the expectation is that top line will maybe grow by 1 or 2% and bottom line may also be slightly flat, and that is also coming after a few quarters of negative or actually zero growth. If you see valuations, we are around 16 times forward price earning ratio, 2.7 times book value, and ROE of around 16.5%, which is slightly 100 basis point lower than long-term averages. However, if you see, there is no actual reason or trigger for any re-rating at this point of time. If we see, there has been some kind of a deflationary scenario even in India. Commodity prices have fallen and almost two-thirds of the earnings of the Nifty is made up of commodity and export-oriented sectors. So those all sectors have been underperforming. Even if you see domestic demand, the rural demand has been very bad, two bad monsoons, and also aggregate demand has fallen. Today, if we see over the last 3 years, the difference between the nominal GDP and real GDP is almost 0%. Nominal GDP has fallen from 14% to 7%, while real GDP has risen from 5 to 7%. So there has to be some amount of difference between the two so that there is an aggregate demand, which is just now not happening. So overall, yes, there is a concern about the demand, the commodity fall, and I don't think the China factor we can just brush aside. For example, Chinese economy has grown at around 13.5% for the last 15 years, and it has become almost 70% market, the GDP of US economy. So, we can't just ignore this at this point of time.
Mehrab, we'll scratch that point a little further in the show, but I would like to understand from you a batch of very decent numbers, good commentary from Infosys, healthy numbers from Kotak, expectedly good numbers from Reliance is already, behind us now. Going into the remaining earnings season, do you feel that the chances or probability of disappointments or weakish numbers or commentary is higher now, and that could also be an added weight as far as markets go from here on?
Yes, Ajay, I would agree with you. I think some of the good numbers which were expected are already behind us, and the market has already factored them into the current prices and valuations. So I think going forward, there are slight chances of disappointment, maybe if I may say, and that may trigger another round of selling in those large cap stocks.
Right. Mehrab, let's talk about that Chinese data point and also commentary coming in from the authorities. For quarter ended 6.9, for the year 6.8, roughly 7% is what they've reported. But, the other economists who watch China very closely and perhaps also invest in them, we were speaking to John Saditsky of Blackstone earlier. In 2016, word is that perhaps they may, go down further in the region of 5 to 6%. If that indeed happens, where do you see the global equity as a scenario, and how would the fund community start behaving in the market?
Yeah, Ajay, if you see, the Chinese equity markets have already collapsed over the last few weeks and also over the last few months. Today, if you see, China accounts for almost 34% of the global GDP, and if you take the multiplier effect on emerging markets, it's maybe close to 50%. So China slowing down is a very big thing, which we can't just ignore at this point of time. Its effect on global commodities is what we are seeing. All global commodities have actually fallen by between 30 to more than 50% over the past few months. So these factors are very important. And China, if you see, is more dependent on infrastructure and exports actually for its growth. Today, if you see, the domestic demand is very low. Even after almost 20% of such high growth, today the domestic demand or the investment or the consumption demand in China is just 35% of the GDP, while in India it is almost 58%, or in US it is around 70%. So China is still dependent upon exports and infrastructure for growth. And once that falters, I think it is entering into a prolonged period of subpar growth, which will affect global markets.
Mehrab, let's get to the action plan, because we often spend so much time talking about the factors at play. But what should one be doing in times like this? Should you get fast and furious about certain stocks? Should you look for sectors where you can hide safely? What's the strategy at your firm, for example?
Yeah, I don't think it is very easy to hide safely at this point of time. But yes, where we are good or bullish on the long-term cycle or those sectors, we are surely increasing. Like as an example, we are increasing allocation towards private banks, which are not dependent too much on corporate lending, because corporate lending has actually collapsed. It's hardly 3 to 4% growth, and we know all the NPA problems which is happening. So those private banks which are more dependent on the rural banking, on the retail banking, I think there we are more positive and we are increasing allocation. Even in autos, I think still the numbers have been decent. The passenger vehicle growth has been decent. The two-wheelers also has been good because the urban growth has remained reasonably resilient. So there also we are increasing slight amount of exposure, and some amount of exposure we are increasing in the certain good technology companies, software companies, where the demand has been good, where the management commentary has been good, and where the outlook has been reasonably positive. So yes, we are positive on these set of sectors.
Mehrab, how are you approaching the mid caps? They have, some of them have really gone up 4-5 times and have corrected on an average 25 to 30% in the last couple of days, with valuation, differential hardly, being there between the large cap and the small cap space now. Do you think there are still some ideas or themes which can give decent returns, or do you think the next couple of months actually belong to the large caps?
There will be individual ideas or themes in any market, but as a segment, if you ask me, I think the mid caps have rallied too much, and a lot of the companies where there is not much confidence on the management or maybe on the demand or the growth outlook, those stocks have also rallied too much. The valuations are not very decent, and when you are getting such good amount of large cap stocks at such decent valuations, I think as a portfolio it is better to be overweight on large cap stocks as compared to mid cap, barring obviously a couple of good stocks which will always be in any market.
All right, gentlemen, Mehrab and Craig, both of you, thanks so much for taking time out here on Smart Markets and talking to us about the strategies that will hold investors in good stead. In fact, let's keep those strategies